Here's something most JEPI owners don't realize. That 8% yield you see on the screen, you're not keeping 8%. The IRS is taking a cut every single month, and depending on your tax bracket, you could be losing almost a quarter of your income before it even hits your bank account. Today, we're putting $100,000 in JEPI right next to $100,000 in ROCY, JP Morgan's brand new ETF that was designed to fix this exact problem. Same company, same expense ratio, very different tax result. By the end of this video, you'll know exactly how much more income you keep with ROCY versus JEPI, dollar for dollar, no guessing. And you'll know the one catch that almost nobody is talking about. Because ROCY's tax advantage, it's not free. There's a cost hiding underneath, and I'll show you exactly what it is. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Why JEPI's 8% isn't really 8%. Let's start with what you already know. JEPI is one of the most popular income ETFs on the planet, $44 billion in assets, expense ratio of 0.35%, and a distribution rate right around 8.2% as of mid-2026. So far, so good. But here's where most people stop. They see that 8% number, they see the monthly deposit, and they think, that's my income. It's not. JEPI doesn't just buy stocks and collect dividends. About 80% of its assets are in large-cap stocks, names you know. But the income, the part you're collecting every month, most of that comes from something called equity-linked notes, ELNs. Think of ELNs as structured contracts, basically debt instruments issued by banks that replicate covered call options. They generate the premium income that makes JEPI's yield so attractive. Here's the problem. Because ELNs are technically debt, the income they produce is taxed as ordinary income, not at the lower qualified dividend rate, not at the capital gains rate. Ordinary income, the highest rate you pay. And we're not talking about a small slice. Based on JEPI's own SEC filings, roughly 85% of what JEPI pays you is ordinary income. Only about 15% qualifies for that lower tax rate. So let's do the math on $100,000. At 8.2%, JEPI pays you about $8,190 a year. Sounds great. But if you're in the 24% bracket, and that's common for a retiree with a pension plus Social Security, about $6,960 of that is ordinary income, taxed at 24%. That's roughly $1,670 right there. Add the 15% tax on the qualified dividend portion, and your total tax bill comes to around $1,855. Your after-tax income? About $6,335. That 8% yield just became 6.3%. And honestly, if you're in a higher bracket, 32% or above, especially if you're paying the 3.8% net investment income tax on top of that, you could be keeping barely 5.5 cents on every dollar JEPI pays you. Now, before I show you what ROCY does with that same $100,000, I want you to take a guess. How much more do you think you'd keep? $100 more? $500? $1,000? Hold that number in your head, because the answer surprised me. Enter ROCY, JP Morgan's tax fix. JP Morgan clearly knew JEPI had a tax problem in taxable accounts, because in March of 2026, they launched ROCY, the JP Morgan Equity Premium Yield ETF. Same management team, same 0.35% expense ratio, similar yield, about 8.16% as of July 2026, and it invests in a similar basket of large-cap U.S. stocks. So far, it sounds almost identical, but the difference is under the hood. JEPI uses those equity-linked notes, the ones that create all that ordinary income. ROCY doesn't use ELNs at all. Instead, ROCY uses something called a call spread overlay. Here's what that means in plain English. The fund sells a call option on SPY, and then it goes further out and buys another call option at a higher strike price. That's the spread. Sell one, buy one. Now, why does this matter for your taxes? Because option premiums collected through a call spread are not counted as net investment income under fund accounting rules. When the fund pays you more than its net investment income, that excess is classified as return of capital, ROC. And based on JP Morgan's own Section 19A notices for May and June of 2026, roughly 93 to 97% of ROCY's distributions came from sources in excess of net investment income. That's the mechanism that enables those payments to be treated as return of capital. In plain English, when you receive ROC, you don't owe federal income tax on it that year. The IRS treats it like you're getting your own money back. So that monthly check lands in your account and you keep almost all of it. Smart income investors hear that and think, okay, what's the trade-off here? Great question, we'll get there. But first, let me show you the side-by-side math, because this is where it gets real. The $100,000 after-tax showdown. All right, here's the comparison you clicked for. $100,000 in JEPI, $100,000 in ROCY. Same amount, similar yield, very different tax result. JEPI, distribution rate 8.2%. That gives you $8,190 a year. About 85% is ordinary income, 15% qualified. In the 24% bracket, your tax bill is roughly $1,855. After-tax income, about $6,335. Now, ROCY. Distribution rate 8.16%. That gives you about $8,160 a year. But here's the shift. About 90% of that is return of capital, not taxed this year. The remaining 10%, roughly $816, is ordinary income. In the 24% bracket, your tax on that small ordinary portion, about $196. After-tax income from ROCY, about $7,964. The difference? About $1,629 more in your pocket every single year. Same amount invested, nearly the same yield, but ROCY puts over $1,600 more in your bank account because of how the income is classified. Now, scale that up. If you have $200K in these funds, that gap doubles, over $3,200 a year. At $500K, you're looking at more than $8,000 a year in extra income you get to keep. And if you're in a higher bracket, or you live in a high-tax state like California or New York, the gap gets even wider. Over 10 years on just $100,000, we're talking roughly $16,000 more in your pocket with ROCY versus JEPI. And that's before you factor in what you could do with that extra cash. Reinvest it, spend it, let it compound. Quick question before we move on. Are you currently holding JEPI or JEPI-Q in a taxable brokerage account, or do you have them in a retirement account like an IRA or Roth? Drop your answer in the comments. I read every single one, because honestly, the answer to that question matters more than most people think. Now, so far, ROCY looks like the obvious winner, but here's where I have to be straight with you. There's a catch, and if you don't understand it, you could make a mistake. The catch: return of capital isn't free money. Here's the truth. Return of capital is tax-deferred income. Big difference. When you receive ROC, you don't pay tax that year, but the IRS reduces your cost basis by the amount of ROC you received. Think of cost basis as the IRS's memory of what you originally paid for the shares. So let's walk through it. You bought ROYC at $100,000. Year 1, you receive about $7,344 in return of capital. Your cost basis drops to $92,656. Year 2, another $7,344. Basis drops to $85,312. After 5 years, you're down to about $63,280. After 10 years, roughly $26,560. Now, as long as you hold the shares, nothing happens. You owe no extra tax, but the moment you sell, the IRS calculates your gain based on that lower cost basis, not what you paid, what's left after the adjustments. So if your shares are still worth $100,000 when you sell after 10 years, your taxable gain isn't zero. It's $73,440. At the 15% long-term capital gains rate, that's about $11,016 in tax. So here's the real question. After that eventual tax bill, does ROYC still win? Yes, it does. Let me show you. Over 10 years, JEPI cost you about $18,550 in taxes, a little bit every single year. With ROYC, you paid about $1,960 in annual taxes on the small ordinary portion, plus that $11,016 when you sold. Total with ROYC, about $12,976. ROYC still saves you roughly $5,574 in total taxes over 10 years, even after the catch. And here's what makes it even better. You didn't just save money, you converted income that would have been taxed at 24%, ordinary income, into a gain taxed at only 15%, long-term capital gains. That rate conversion alone is worth hundreds of dollars. But here's the part I think is the most powerful for anyone watching this. If you hold those ROYC shares until you pass away, your heirs receive what's called a step-up in cost basis. That means the cost basis resets to the market value on the date of your passing. All of that deferred gain, the $73,440 that you would have owed taxes on, it disappears. Your heirs owe zero capital gains tax on it. That's the real power of return of capital for long-term holders. It's not just deferral. If you hold long enough, it can become permanent tax elimination. That's not a loophole. That's just how the tax code works. So, who should actually make this move? Let me give you a simple framework. Consider ROIC if you hold JEPI in a taxable brokerage account, if you're in the 22% bracket or higher, if you plan to hold for the long term, and especially if you plan to eventually pass these shares to your heirs, because that step up in cost basis turns tax deferral into tax elimination. But, and I mean this, don't swap if you hold JEPI in an IRA, a Roth IRA, or a 401k. In those accounts, you're already tax sheltered. The ROIC advantage is completely irrelevant. JP Morgan's own notices say this explicitly. The source information may not be relevant for retirement accounts. If JEPI is working for you inside an IRA, leave it there. Don't swap if you're sitting on large unrealized gains in JEPI. Think about this. Selling JEPI to buy ROIC triggers capital gains tax on the sale itself. If you've held JEPI since 2020 and your shares have appreciated, that tax bill could wipe out a year or two of ROIC's savings. A smarter move, keep your existing JEPI, redirect new money and reinvested dividends into ROIC going forward. And think carefully if you need a proven track record. JEPI has been around since 2020. It has $44 billion in assets and 6 years of real-world performance. ROIC has been around for 4 months. Its assets are about $223 million, a fraction of JEPI's size. And here's a critical point. JP Morgan explicitly says the return of capital classification is not guaranteed. In certain market conditions, distributions could be reclassified as ordinary income at year-end. We won't know ROIC's actual 2026 tax character until the 1099 DIV arrives in February of 2027. So here's how I'd think about it. Don't rush. Watch the monthly 19A notices. Consider directing new money into ROIC and wait for that first full year at 1099 before you go all in. If someone you know is holding JEPI in a taxable account and complaining about their tax bill every April, they need to see this video. Share it with them right now. Same yield isn't the same income. What the IRS takes determines what you actually keep. I'd love to hear from you. After seeing this comparison, are you considering ROIC for your taxable account, or are you sticking with JEPI? Tell me your plan in the comments. If you're building income from your investments and you want to stay ahead of changes like this, subscribe to this channel. I break down every new product, every tax strategy, and every number that affects your money.